So the past few months have not been easy, and unfortunately for majority of investors, the pain both mentally and physically is just getting started.
The market is now pricing based on an expected recession.
As the markets continue to get weaker and weaker, your patience, your ability, and even your own self-confidence is about to be severely tested. And what's worse is even after watching this video, the majority of you are still going to go away and do these mistakes anyway. And trust me when I say it's going to cost you a hell of a lot of money. Now, the majority of people watching my channel are actually blokes aged around 35, which means during the 2008 crash, the last big recession, you were just a baby in an adult's body. You were too busy trying to figure out how to go and talk to the hot girl in the bar, trying out new chat lines like, "Are you a shark? Because I've got some swimmers you can swallow," which weirdly never worked. But back in 2008, a 35-year-old didn't give a monkey's banana about what was happening in the stock market. I mean, why would you? Katy Perry just kissed a girl and liked it. But fast forward to now, hopefully you've matured somewhat and realized Katy Perry's not into girls at all. In fact, she married the weird elf from Lord of the Rings. But you've probably also realized that maybe you should have paid attention to the stock market, because that was the lowest point and the lowest entry you're probably gonna ever see in your lifetime. But with the next stock market crash being pretty much here and these opportunities about to arise again, there are some huge mistakes majority of retail investors are about to make. And the weird thing is, these mistakes are made by investors time and time again in every single crash. And again, to remind you, majority of investors are going to make these mistakes whether I warn you of it or not. So the first mistake investors tend to make is not smashing the like button on this video. And yeah, that was very cheesy, and you still haven't done it yet, and it's getting kind of awkward.
Okay, I'll do it.
But seriously, the big mistake that investors always seem to do is an obvious one, and that is selling their investments. But bear with me, because this falls into two very different parts. First up, we have the obvious one, the panic selling, where an investor just can't take any more and they realize their loss. Every investor in a bull market always spouts out, "I am a long-term investor, and this is a 25-year plan or process." But in a bear market or a recession or a market crash, this theory is really put to the test. I mean, ask yourself this: when was the last time you checked the balance on your portfolio, or how much you're up or down on your investments? And let me tell you, if the answer was today, you are one of the vulnerable people who this applies to. A stock market decline could cost you dearly, as you are a prime candidate to go back on those words you once spouted of being a long-term investor. Because every single day you're gonna wake up, check your balance, and realize more and more unrealized gains, more and more red. And eventually, your mind and body just will not be able to take it anymore, and you will not have the right frame of mind when you do it, and you will sell everything and feel just a little bit better about your life. The urge to stop your portfolio from bleeding can be overwhelming. Trying to salvage every little penny you can and wait for the dust to settle with the hopes of one day investing back into the market. But ironically, this pain relief is one of the most damaging things an investor can ever do. Selling into a falling market does nothing but ensure your gains are locked in forever. And if you take your time getting back into the market, you may never recover at all. Consider this: somebody who just started investing in 1980 into an S&P 500 ETF, and all the way from then up until February 2022, they would have accumulated around about 12% annualized returns. Compare that to somebody who tried to time the market, somebody who panic sold when the market was falling down and then waited 2 consecutive years to buy back in. They'd have only made 10%. Now, that might not sound like a huge difference. After all, what's 2% between friends? But if these investors were contributing just $5,000 US a year, the first investor would have a staggering $4.3 million US, whereas the person who flip-flopped and tried to time the market and couldn't take the pain anymore only has $2.5 million, which has cost them, in essence, $1.8 million US for not sticking to their initial plan of being a long-term investor. You see, you need to have the long-term mindset, especially if you're quoting it, and more so, you need to stick to it at all costs. But of course, this only works if you've bought the right assets in the first place. Many investors in the dot-com bubble held on to their tech stocks hoping they would one day recover, when in reality, 52% of these companies didn't exist a mere 4 years later. And some massive companies like Cisco Systems, a company that was established way before the dot-com bubble was even a thing, has still not recovered today, some 22 years later. But investors held on to these stocks stocks nonetheless because they were in love with them and how much they could disrupt and change the world in a good way forever. Which, when you start to think about it, sounds eerily similar and familiar to what's been happening over the last couple of years.
Well, I find that very interesting.
Companies with no revenues or cash flow will always find it harder and harder to survive when the market turns south. So make sure the companies you are buying have solid fundamentals, solid thesis, solid cash flows, and overall look quite healthy. Or the other option is just go and regularly buy an S&P 500 ETF. But let's be real here, no one here is buying an ETF because it's super boring and you're so scared you will lose all your mates because you haven't also YOLO'd into some Tesla. Now, the second big mistake that majority of people watching this video are about to make is probably the hardest one to do when the market is in its worst ever situation, and that is just buying more of your investment. And this is not just because of the mental reasons, but more the reasons within your lifestyle. You see, you could be in an area where you might have just lost your job, or money could be tight because of high inflation, or where we are right now. Both are very serious possibilities. It's super important that you continue to regularly invest into your investments, whatever your plan is. And taking a payment holiday when the market is at its lowest buying in opportunity, maybe in your lifetime, will literally cost you millions in the long run. One thing I've always tried to express to my clients in the past was always make sure you have at least 1 year's worth of savings to continue paying into your retirement plan. And this is excluding your safety fund. Just make sure that's there because it operates a good discipline in your mind that if you did lose your job, it allows you to continue to take advantage of a down spiraling market. The general way that the financial world actually works is unfortunately a bad one. The times that markets are at their lowest point are also the time families and individuals have little cash flow to invest. And whether that's from fear of investing into a market that could fall further, or just simply you don't have enough capital to invest. In most cases, arguably both of these points would be valid. So I would stress to anybody watching at this point in the video is think about what job, what side hustle, what money making method you could do if you lost your job tomorrow to not only make sure you have enough to invest, but also enough to pay all your bills, and then go and do it in your spare time and start that. Jobs are starting to be lost and they will be continuing to be lost in the coming years. It's gonna happen. So make sure you protected yourself and also have enough money to continue to take advantage as the market continues to fall. And on that, I want to put in a shameless plug here of a feature on eTORO, and that is you can set up a recurring deposit where it automatically takes a set amount of money from your bank card every single month. And what's more is if you're now from the States, majority of states you can actually trade stocks and crypto via eTORO, and if you sign up, deposit $100, they're going to give you $10 to kickstart your investing journey. And whether you're from the States or the US, if you sign up via the links that are pinned on the comment down below, you will get a lifetime pass to our glorious chat room. Just make sure you use the relevant link whether you're from the US or from elsewhere in the world. But to clarify on point number 2, the key is to be continuously investing and taking advantage as much as you can of down spiraling markets. I remember speaking to my father about stocks and him telling me that the stock market is a complete gamble, and at the core of his argument was he watched his dad, my grandfather, lose pretty much everything he'd invested in the 70s. As inflation took over, the market crashed, an eerily similar scenario right now. But this negative experience from my granddad passed on to my father, and to this day, he's never ever bought a single stock. I think when the market actually rallied after the whole crisis in the 70s, that it sort of put him off forever. He never bought another equity again because he'd watched himself sell out at the bottom and then didn't have the conviction to buy back in at a lower rate and watch the market rally. In essence, he lost his money for absolutely nothing other than being impatient. But unlike my granddad, I'm not going to sell at the bottom. I'm going to continue investing on a regular basis. Now, the third mistake is something that every investor has made, myself included, everybody who's a new investor in the chat room, and people who I just speak to at one of my businesses. It's something everybody brings up, and that is trying to catch a falling knife. You see, many people overestimate their actual ability and capabilities of picking stocks and assets. This whole buy the dip mentality that's floating around on YouTube is actually in essence more like trying to catch the falling knife. You see, when people see a stock chart that's fell 80, 90%, they think it has to go back up at some point. Let's look at AMC as an example. If we go back to May 2021, AMC is down about 80% from that peak. And many new investors will look at the chart and think it's got to recover at some point. That's cool. I'll just buy in and wait for that to happen. And it couldn't be further from the truth, because this sole argument would mean that AMC was correctly priced back in May 2021, and we all now know that wasn't the case. It was actually just a short squeeze that wasn't a short squeeze, but that's for a different video. People need to wake up and realize that stocks are actually hardly ever, seldomly priced correctly at the price they trade at. There's always massive differences whether they're overvalued or undervalued. It's very rare you find a stock perfectly priced. Another example is a $170 billion company I touched on earlier, Cisco Systems, which employs 79,000 people, a huge company. But because this was a tech company and was around during the dot-com bubble, its prices just got out of hand. So much so, if you did buy back in, that's a minus 45% return for holding a company for 22 years that actually has a good foundation, cash flows, and even turns a decent profit. Investors really do these days need to wake up and realize that the chart is just for traders, and buying the dip does not always work, and usually it's catching a falling knife. The chart is for traders, and the fundamentals and the balance sheets, that's for us investors. Remember that if a stock seems cheap on the chart or even cheap in the fundamentals, usually there's a reason for the bargain. I mean, if you were buying a car from a sleazy salesman saying it's so cheap to be true, you'd obviously check it under the hood and see what the smelly fish is. And if he didn't tell you, said no, it's perfectly fine, you'd be testing the shit out of that car, checking under the hood, making sure everything works. And it should be the same with a business, by checking the cash flows, the fundamentals, the debt, absolutely everything that is the engine of the business. In other words, don't buy the dip, buy the valuation of the underlying business. Now, investing losses are painful. I get it. And the more you look at your account and see red on red on red, it's increasingly more painful. I completely get it and sympathize with you. But if you do not panic sell your stocks, but can sell the ones that you have less conviction of or don't make sense anymore, and if you can continue to buy into a falling market with unrivaled conviction and continue to pick businesses with good fundamentals and good cash flows, and if you can do all of these things at the same time, well, it still might not be enough for you not to lose money. But by following these simple mistakes that majority of investors are going to make in the coming months and years, and listening to principles from legendary investors like Warren Buffett, you may increase your chances of reaching financial freedom. And I actually talk about Warren Buffett's 3 big principles in this video here. And if you could drop the code word down below in the comments, which is mistake, it would greatly help me out with the YouTube gods. Best of luck out there, folks, and I'll see you in the next one. Peace.